Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, August 17th, 2022. Just one more reminder, I'll be away from my desk all day Friday and through Wednesday on vacation with very limited access to the computer. So posts will be, if anything important, I'll bring a laptop and try to get some updates out to you probably after market closes. Be doing a lot of fishing and diving down the Keys. So we'll also be prepping for that trip. So posts have been light this week, will continue to be, but here's what I'm going to do in this video for you. Go over some of the recently highlighted trade ideas, and then a little bit of a deep dive in the market, the stock market that is. Look at some of the top components. Real quick, an update on the natural gas trade I threw out there yesterday. We now have a secondary sell signal, or the add-on, or the, like I said, more conservative entry. Since we didn't have any hard sell signals yesterday, I posted that one as a play into this resistance zone right here. I had a shaded area on the screen capture software. I can't add it to this chart, but that's the resistance zone I showed you. So we have the highs there. This is where natural gas continues to run up to, and the seller, it's been met with sellers each and every time. And that's why when you're in a resistance zone, it's anywhere from the top to the bottom. But now you have an actual an objective sell signal here. Let me zoom in. That's that little wedge I gave you, the minor uptrend line, and it broke down, and plus that divergence. So where I would let it run for now. That's my plan. I added to it today because we broke down below that level. I would say at minimum probably coming back down here. Well, you can, okay, minimum going to be the minimum levels. You can see my levels marked: 898, 8694, 8368, and that's again at least a minimum target based on these divergences and everything else there. So nothing more to add there. Crude oil. So short natural gas. I actually went long crude today. Let me show you why. This is a 10-minute chart. I'll zoom out to the 60 in a minute, but this is kind of helps hone down the entries and exits. Nice little positive divergence here. That was a divergent low. We made an almost equal low with the indicators making much higher lows. That's positive divergence here on this 10-minute chart. I think if we can pop back above 87.80, I think you'll see some short covering. It was a pretty decent level right there. A lot of reactions on it. Yeah, we went through it a few times, punched through it, but always recovered it, and then it's been resistance. So that would be an add-on point there above, again, a solid break above 87.80. Again, that's just a very short-term chart, 2 weeks of price history, 10-minute chart. Here's what it looks like on the hourly chart, which is kind of my go-to swing trading time frame. I look for these divergent highs to get short. Bring you into a downtrend. Then you look for these divergent highs to either cover shorts and or go long. Obviously, again, what I just showed you is I hone in. I look at shorter term charts as well as the 60-minute charts for trend lines, price resistance, reasons to initiate or add to a position. Divergence, I always say, is not a buy or sell signal, merely an indication that momentum in that current trend, this downtrend, is waning, and you're likely to get a trend reversal, just like you did here, just like you did at that divergent high there. You went down, that was a DH, and that's it. I don't have any hard targets now, and being the fact I'm not going to be in front of my desk, I'll get something out. I'll follow up in here, and you could see on that 10-minute chart we had some near-term micro levels, but on a 60-minute chart, you're usually good for trades that are going to last at least a few days. I would say, looking at a good at least from where we're at, about 4+% rally, possibly more, and stops below the recent lows on that. All right, let's get to the stock market now. Crypto, I'm just going to say, and I've been saying it, it's been a highly correlated trade with the stock market. So to be, when the stock market's rallying, to be long bullish equities is to be long bullish crypto, and everything else. I said, all these meme stocks. This is exactly where I figured we'd be months ago. After reversing, closing all longs, pivoting to closing all shorts, pivoting to longs, and then building those positions back when the market's bottom on June 16th. Give you a max bounce target range, and this is what it looks like and feels like. And I look at comments, and I know comments from a few on the site aren't representative of everybody out there, but this is This is what it feels like. This is, the biggest part of trading and getting in front of the charts. That's why, one reason the site's right side of the chart. Anything to the left, which is what we're looking at here, all this stuff is history. So we take that, and this is the right of the chart, or right of where price action is, and it's the future. And you take this to predict what's going to happen over there. Part of that's herd mentality and psychology. All the analysts and even investors that are bullish and clamoring for higher highs now and calling for a new bull market and all that, they didn't want to buy here, here, here. They didn't want to buy these dips. They want to buy after a 20+% rally, and that's where and you can see it. You can see the risk on. You see the cryptos rallying as expected. You can see those meme stocks, Bed Bath and Beyond up what 300, I think it 300% in the last few days, things like that, AMC. And so the same Reddit crowd, and no offense, because I'm sure some following the site do this and trade those. And hey, I traded the meme stocks. There's nothing wrong. I'll trade anything with a ticker. I don't have to believe in the fundamentals, whether it's Bitcoin, crap stocks, penny stocks, if the charts are constructive. So, but where I'm going is, we all know those tend to be the unsophisticated investors, and for the most part, investors with absolutely, and traders with no experience or knowledge, and just buying because everyone else is buying, and that makes things go up. And that's where they were buying the AMCs and the Bed Baths and Beyond, all those meme stocks back there, and Bitcoin and everything else, which all peaked here. So this is what you get. This is, we're back to a risk-on environment. But if it is a bear market with another leg down, that's what it's going to look like. So we're getting signs. We're starting to get some pretty good evidence that's indicative of a more lasting top. Again, with that return back to, I'll call it what it is: crap stocks, crap investments. Things with no fundamental value, things that are way overpriced, and momentum investors come in. So whether this is the end or not, or we push up to the 200, which again, my max bounce target range is that 200-day simple moving average. I don't know, but let's look at what we do know. We know that the PPO is at very high levels, poised to make a bearish crossover. I've covered that before. Here's a high-level bearish PPO crossover right there. We had a high-level PPO crossover right there. Went over, did cross back above, and another crossover there, crossover there. I'm talking about bearish crossovers, guys, when the orange line is above and it crosses down below the white line. And you can see that by putting on your PPO histogram, and when it goes from green to red, there's your crosses. So here's a big green hill, I call these things. And there was the last green hill, and there was the last crossover right there. There was a big green hill there, and so forth, so on. So those are the things I'm looking at, some of them. And let's talk big picture now. All right, big picture are the weekly charts and the monthly charts. This is the weekly of QQQ. We have this primary downtrend line right here, and we pretty much closed about on it last week, a hair above it, and we're trading a hair above it now. But again, that's not a solid weekly close on a weekly time or any time frame you're trading. You want to see a solid close. It's clear. You put that level in the rearview mirror. So we'll see where we close this week. I suspect we'll close back down below there, and then that would be a false breakout or failed breakout again of the downtrend line off the highs right here, if that happens. But you also have this uptrend line off the lows. This one I think is very significant. It's pretty clean. And if you see a solid weekly close below that, and then the next level, big level, is about 318.50 right there. That was really good support. Back here, support. We broke it there. We rallied back, tried to get above it, rejected, resistance. And so this is kind of a battleground here for bulls and bears. And there's that key 200-day, I'm sorry, it's on the weekly chart here, 40-week, but this is the same as a 200-day moving average. And we're getting close. Again, a little more upside if the market wants to push it. But, the way the markets tend to work is, I pointed those lines out, the 200 simple and exponential is potential bounce targets and objective short entries back here. And you got rejected off the 200, right? Right there. And then you got rejected off it again, and then again the following week. And so all eyes are on it. Is it going to be that easy? No, the market rarely makes it that easy. Now a lot of traders are probably tuned into that 200. So one of two things tends to happen when all eyes are watching a level. You either get rejected, the sellers step in early before it's hit. The greedy longs are holding out to milk out the last cent. And short sellers are waiting for that optimal entry. I like to scale in. I've told you my thoughts. I have hard bottoms like that one, close all shorts, reverse the longs on one day, and then I have soft tops and bottoms where it's a range, and I don't see any screaming hard sell signals, or reasons to do the full reversal. So you scale in. And now where I'm going with that is the other option is, or the other likelihood, I'm sorry, is that if we don't reverse shy and deny those the short sellers that want to short the 200 and the longs that want to get out, if we don't deny them that optimal entry, then you go and you punch through it, and then that causes around a burst of short covering. Those that are short or shorted at it, they'll get squeezed. You'll have additional longs pile in, calling for a bull. Look, on face value, it would be bullish if you take it out on a solid weekly closing basis. This is a weekly chart we're looking at here. And if you're trend trading, which is what I am talking to now, the longer term positioning, then you want to trade on the weekly chart. You want to definitely be a little patient, because it's more than common. It's almost guaranteed on an intra-week basis to punch through support and resistance levels, only to see those levels fail by the end of the week. And then big level back here, 350.70. Just because that's my max bounce target zone doesn't mean if we don't go there, I'm not going to be talking about the same thing, because I will. That was my first target. Remember, on the weekly chart, we had the initial short there, second short there. Every bounce back to that level was highlighted as an objective short entry. The breakdown below that 378.86 level was, you got that. That was nice support. Remember that trading range I talked about, that sideways trading range? There was a downside break. And then every pushback to the 200 days. So as far as the trend trading, that was it. We hit my first target there. We hit my second. We hit my third, where I talked about reversing for a nice 20% or so rally, which is exactly what we've had. And now I'm looking for this. And if you're new to the site, I'm talking right now what I call my max near-term target, and I try to be careful on my definitions because it can be confusing at times. I wear multiple hats: active trader, day trader, swing trader, trend trader, investor. And investing pretty much to me is limited to trend trading. Rarely am I going to hold anything for more than 4 or 5, or a few years or a couple of years. But either way, that's a very, very nice and likely pullback target that if we get there, I think there'll be a lot of buyers step in. It's dual support. It's that big support right there, the resistance. Remember back here I was highlighting what I was referring to. This is called a ascending triangle pattern, and that was our buy signal, the breakout, and then we back tested it, and that was powerful stuff. So it's dual, not just dual support, very good support levels, where again, if we get down to it, which I think we will, a good chance we will at least, the buyers will step in. And that's a big drop. From if you've been shorting this just in the last few days, I'm just going to measure. If we drop there from the highs, I'll just pick the high and play that game. That's about an 11% drop if we get there. But I give you near-term targets. I need to add one. I told you 319 would be the next target, and I was wrong. There's a gap right there, big old gap, and it was back tested from above. 323. That's going to be your first or next likely reaction point if and when hit. That's not an arrow tool. That's an arrow tool. So something like this. And then ultimately work our way down there. We'll see. Work to be done. I will acknowledge the bid has been voracious. Every little dip, every little sell signal we've had in recent weeks has been bought up, or you get a little pullback, but then the buyers step in again. The headlines are saying the Saudis have pumped in billions of dollars. They won the lottery. They hit that Powerball, that big one that paid out recently. What was it, $1 billion or whatever? When we went to the big green plan when when the current president was elected, and oil prices started from that point rallying, and they were already in a huge ascent, and then of course the Russian invasion of Ukraine. So and here we are, passing, just more green energy stuff. So that's just caused the price of crude to just go crazy. And the Saudis have pumped tremendous amount. Their windfalls from the skyrocketing oil prices have been tremendous. And that's. But again, here's the thing. That's part of what this is. The headlines are coming out now how much they've been buying the big market leading FANG stocks, the same ones that I was harping on back here. That would be my preferred. You can trade anything you want when the stock market's going up, but I said go long into the in the market leading FANGs and tech stocks. That's what's going to go up the most, and that's what has, because that's what everyone wanted to buy when you get a bear market rally, big drop like that. And again, so I maintain what I've been saying for the last few weeks. I think we sheared most of the meat off that bone, possibly all of it. We'll see. But let's go through the charts and wrap this up. All right, so that trend line on the weekly chart, you want to see the uptrend line. It's not off the lows. I have it drawn here, coming in that bottom of that candle from that's the week ending July 15th right there. Pretty well defined. You can see something similar, I think, on the S&P 500. Here, draw it here, like that. So you can see we have these uptrend lines going, small caps as well. There it is. This is what you want to see break. See, the small caps have already hit the 200-day, which is the 40-week simple moving average. Let's see where the S&P is. S&P just hit it too. Perfect tag, well, near perfect tag. We hit it this week. There's your uptrend line right there. And that's it, guys. So this is, and I say this and I repeat myself often because, hey, I'm either going to be right or wrong. But if I'm right, there's a decent chance that this is the end of a bear market rally. And although we're not going to go straight down, we're going to zigzag down, and it could be a very lucrative time to exit longs if you took them back here, here, anywhere along the way, and or get into swing trend shorts for what could be the next leg down in the market. And that's why I do these long-winded videos covering all the different things that I'm seeing. Remember, my job isn't to tell you what to buy or sell. It's just provide analysis, what I see. I'll tell you what I'm doing, and then you decide if if that meshes with your own analysis or not. Okay, here's what I'm gonna do from here. Should only take maybe about 12 minutes or so, and we'll wrap it up. I'm just going to walk through the long-term charts of I'm gonna focus on the leading index, Nasdaq 100, chock full of the highest, fastest growing companies, the biggest companies, and there's a lot of these are top components of the S&P as well. So they are the market. The market goes where they go, not where the small caps go. They don't move the needle. There's 2,000 stocks in the Russell 2000. There's only 100 in the Nasdaq 100. But even the top 5 alone in the Nasdaq 100 dwarf the 2000 or the impact on the market than those small caps. So that's all we need to focus. If we can figure out where Apple, Microsoft, Amazon, Tesla, and those guys are going, then we know where the market's going. It's really that easy. So that's why I do these videos and hyper focus on those. All right, this is the longest term chart I usually use, a monthly chart. I can scroll back a little, but we're just looking at what I've maintained. I'm different from, CNBC and all that. And I use a definition. I tell you, we're still in a bull market. We've had plenty of bear markets along the way, or a couple, I should say, since the lows and back in 2008 in the NASDAQ and early 09 and every other index. But you can look at a chart. You do not have to be an expert technician, chart reader to say, well, this is a bull market. It's a secular bull market. Within there's been cyclical bears, if you want to call it that, but they're just corrections. That old antiquated, you've heard me say it 100 times, that antiquated definition of a bull or bear market being a drop of 20% or more needs to have long since been retired. Every security is different. There isn't any one value, but if you want to say the stock market, I don't know, pick a number, say 30, 40%. It's a lot higher because there's a lot more volatility in this. The trends are much bigger nowadays. So there was the last bear market, 55%. I think it's safe to say that was a bear market, 07 to 08. These are the corrections. And then one of, but not the only reason, for going long off those lows and reversing, covering shorts was we hit a major bull market, my bull market uptrend line right there. It is super well defined. It really doesn't get any better than that. You have those couple lows back there. You had that flash crash in the Qs in 2015 that hit it perfectly. These are reactions. Two candles there, another two candles there, the bodies, and then right there. So, okay, so yeah, we just hit a major long-term trend line. Yep, went long, but why do I not think we're going to go up much more? Well, all trend lines ultimately get broken. Just like that last one right there, there was a bull market trend line, breakdown, back test, and that was it. We had one there, breakdown. And so this one's getting long in the tooth. A lot of the things such as the indicators, divergences, and et cetera, tell me it'll be broken. And then I also have, in addition to that trend line, which I put a very, very good weighting on, and just so you know, if and when that breaks, that has much longer term bearish implications. Not a 3 month, 6 month drop, but probably a year-long plus drop. Could be multi-year drop, and probably bring us down quite a bit lower in the markets. Now we're comfortably above it, so don't freak out, and we'll react with when that happens. But the other level I absolutely love here is this 40-week, or I'm sorry, 20-month. It's an exponential moving average on the 20-month. If you follow the site for a while, you've heard me cover it a lot, but it just does a great job of defining bull and bear trends. And don't look at the skinny part. Those are intra-month moves. Look at the fat part, the body of the candle, and you'll see that you'll have tags. Sometimes you tag it with the tail or the shadow of the candle, but it's only a sell signal if you have a solid monthly close below. And it has just done a bang-up job. Call it your 401k indicator. If you want nothing else, shut down the computer and just watch this, and you can trade off this, and it would be a great guide. And you can go back in time, and I've covered it, and there was a dot-com bubble. You buy all the pullbacks to it. You stay long and strong until it goes. And there was a solid break, and it got you out. And if you heeded that warning, even if you waited to the end of the month, you would have saw heading into the end of the month that you had little chance of recovering it. So let's just say you did that, week into the end of the month, and it looked like you had no chance of recovering. You got out of your longs, you shorted the market. So you either averted a almost 70% more downside in that bear market, or in the Qs. Remember, the Qs dropped from high to low 84%. So we either averted giving back 70% of your portfolio from that point, or you turned around, cut the losses on the longs at that point and shorted the market and got some or all of that, and turned it into a profit. So, all right. So where am I going? That was it. There was your sell signal. Usually when it's broken, any back test you can't see it here. I'd have to zoom in. I could, but it would take forever. You back tested it the following month. So if you missed that sell signal there, you had an objective exit on your longs and a new short entry. The following month you made a perfect back test. You can zoom in, replicate this on your own. You went through it there. Finally gave up the ghost. And look, here's the point. There was our sell signal, as I mentioned there, back on the month ending in April. You back tested, and there was again your objective short entry. And where we're right now, well, we're right about on it. Right on it right now. So if we rally hard, it's today is August 17th, so there's a couple weeks left. We could recover it, and then hey, I'm gonna have to recognize that as a bullish technical event. Should we get rejected and close either on it or back below, then it's just another back test from below. So all I can tell you from a trend perspective, this is an objective time to exit longs and or get into trend short positions, or use those shorter term charts if you want to kind of zero in on that, because the monthly charts, the problem with trading solely the monthly charts is that by the end of the month, if you're waiting, you could be way up. I'm probably not going to do that, but you could be way up above there. So you just kind of use it as a guide as well, like I said, 401k stuff, or to confirm what the current trend is. That's where at times when we're rallying into resistance, you know me, I'm either going to look to position long on a breakout of that resistance level if that's what I suspect will happen, or I'm going to look to short and rally into that resistance based on my, yes, dirty word in trading, but bias. Everyone, it's hogwash. People say you can't have any biases in trading, just trade the charts. Well, you need to know whether you want to, short a rally into resistance or wait for a long breakout, or even ignore a long side breakout because you suspect it's going to fail. So these longer term charts help formulate my bias, and that helps me figure out what to do on those 60-minute charts and daily charts. So that's that. All right. Long-winded video, but I'm going to get to this in a second here. This is Apple. I'm not going to cover them all in a monthly time frame, but this is the market largest stock out there, biggest impact on the S&P and Nasdaq 100. And you can see what I have here. This 30-year chart highlights the cyclical bull market tops and bottoms, as well as the primary uptrend lines which defined each bull market in Apple. The percentage of each drop was calculated from the previous bull market peak to the bear market trough, which are the arrows. And so you can see we had a bear market of 59%, 70, 74, 83, 42, 62, 45. At this point, I said only a 32 drop, meaning I suspected there'd be more, and sure enough, there was more, based on, again, everything. You can go back, it's all on the site, everything's archived. And then 34%, so that was about over a year-long drop. 39%, and so I just updated this today. Measured from the top to bottom, 29. You see my question marks, as in I don't think that's it. So this is a monthly chart of Apple. These also, if you notice all these big, well into the double-digit drops, guess what they all have in common? Look down below. This PPO indicator going red, just like on the stock market, on the monthly chart. And when it's red, you're in a bear market. And we are solidly red right now, meaning the PPO is telling you you're in bearish territory. There's my primary uptrend line right now in Apple. And that was also one reason for covering long. Apple, among the other many stocks, hit long-term uptrend line support or other support levels, and we bounced. But we are now back testing. I've had this line on this chart for a long time, and we're back testing that below. This is a price channel right there, and with divergence, negative divergence on the indicators. I don't know where the lines went on the PPO. Sometimes they just seem to disappear on this platform. And that's it. So where does Apple go before all said and done? Got some pretty aggressive targets, but I think down here, this longer term trend line, and if it does, and I'm right on that, it's going to be ugly for the market. That's about a 60% drop in Apple. I ain't going to get there today, tomorrow, next week, next month. That's a target out a year, couple of years out even, but you won't want to be long if that plays out that way. Take it down to the weekly chart. We're going to do this on all these stocks too. Let's talk fibs. I'm not talking about lies, talking about the real deal. Fibonacci retracement levels. Amazing how well they work. This is Apple. These are your fibs. So you measure from the highs to the lows here, and you got a 78.6% retracement. That's where Apple's trading right now this week. That's what it hit and closed on last week. We're right in close enough proximity this week. Key fibs. I'm just going to walk through all these market leaders, show you the fibs here. Again, I'm just measuring top to bottom. Microsoft at the 50% fib, almost hit it to the button, close enough. Also, you can see that 40-week, aka 200-day moving average, key level. Right there, dual resistance. And that's Microsoft. That's number 2, second largest company behind Apple. Amazon, double top high right there. See these two highs, measure the fibs there. Ran into the, like a brick wall, the 50% fib and the 200-day. Dual big resistance levels I talk about all the time. Hit it last week. Tried to take it out this week. So far rejected. And back down below the 50% fib and the 200-day, aka 40-week. We're looking at moving average there. Tesla, right at the 50% Fibonacci retracement level. There's the 50% fib. Rejected 2 weeks ago there. Right, no, that's not an arrow tool. Rejected 2 weeks ago on there, and rejected again this week at the 50% Fibonacci retracement. Alphabet, weaker than the other ones. It's only retraced 30, hit the minimum, well, not minimum, there's a 23.6 fib, but this is a 38.2 Fibonacci retracement. That's where it's at. And that 200-day exponential moving average, which is on the weekly chart, the 40-week or 40-period moving average. And that's where that one's at. Meta, so weak it hasn't even retraced that minimum 23.6. Just super weak. This is a company that has just pretty much been taken out to the shed and shot. Um, and it's just, the death of a former market leader. And just here, I'm going to go back to that and just show you. Just keep in mind, this is the old Facebook down almost 60%. Those bear market stuff here. Market leaders don't drop 60% in a bull market. So NVIDIA, also one of the biggest components of the NASDAQ 100, right behind Meta. And you have Fibonacci retracement of that minimum 23.6% right here. You can see it. 23. I know it's hard to see in the video. That's why I'm calling these levels out. Hit it a couple weeks ago, last week as well, and so far. So that's what's capping this one right now. And we're, what these are, these fibs, it just shows you there's no guarantee you stop there, but they work, and I like to use them in conjunction with price resistance, trend line resistance, moving average resistance. And what they tell you is in a typical counter trend rally, which means, let's say you're in a bull trend, a counter trend would be a pullback or correction. And in a bear market, a counter trend move obviously is a rally. And typical retracements run from, usually I like to see from the 38.2 to the 61.8. Those are just average or typical retracements. So there could be plenty more upside and still keep this thing in a bear trend. You'd see we'd be below that previous reaction high, even on a 61.8 retracement. But right now, the semis are weak, and we're short the semis again. We've been long, short, and I'm digressing a minute, but there's that SOX trade playing out nice. Shorted it here, breakdown. We had a back test of the wedge, gave you another short op. Look at that, divergence stayed intact, and they're starting to move impulsively lower. And that's a sector that has, this is the canary in the coal mine for the tech sector. The semis, they're the leading indicator, and tech is the market. Tech is over 50% of the NASDAQ 100, over 25% of the S&P 500, which is by far the largest sector. And you can see what happened here to SOX, the semiconductor sector. Rejected at the 200-day twice, 3 times, 3 weeks in a row. We've rallied up, hit the 200-day, aka 40-week moving average, got rejected. Just like the markets here, what I suspect, tried to take out this downtrend line and failed so far. And let's see if I have fibs. Nope, I'll throw them up here. Let's just throw up the Fibonacci retracements. High to low. And look at that, rejected on the 38.2. Okay, I could go on, and I do. I do that on my own. I sit here and look at, sometimes I'll go through all or most of the 100 components of the NASDAQ 100, other indexes, sectors, but you get the point. And again, you go down the line, as I continue down, I have that watch list I've been cycling through sorted by market cap. So it's those big ones that have an overwhelming impact on the indexes. And as you start to go down the line, get past the top 10, even past the top 5, the weightings are a lot lower, so it doesn't have the impact on the market. So let's just wrap the video up with the near term. That was all long-term stuff I'm showing you. Near term, here we go. There's your sell signal right there. There's QQQ. Here's our wedge, bearish rising wedge. There was that minor trend line we broke yesterday, hit that key, what I call the key 330 support resistance level. So now that tells me, as I suspected, that break above 330, it was big resistance. We took it out unimpulsively, low volume, negative divergences. As I often say, breakouts that occur with negative divergence often fail, and now it failed. So a lot of things have happened in the last 2 days. Number one, we broke down the minor trend line, sell signal 1. We hit the 330. First time we hit it, of course, the buyers are going to step in. It's the first test of it from above. Once we took it out, it bounced, made a near back test pretty much of the trend line. And then ran at it and then took out 330 this morning. That's the post I got out to you today. Then we took it out, so that's a sell signal, and it's confirmed with a solid close. Now a second close below, and now the hour isn't over yet. This candle's still forming. It has another 15 minutes to go. If we can close down, especially towards the low of this, low of the day so far, which is, you can see here, 327.05. then you'll have what I like to see, a solid 60-minute close below there. And that should open the door to that 323.12 target I gave you in the beginning of the video. That's a big old gap. If that gap is entered from above, buyers will probably step in, but then gaps once entered are usually backfilled. However, I had that 319 support just above it, so I think the buyers will step in there first and then work our way down. So, and if not, something else is happening. Like I said, unfortunately, I'm not going to be around much from here on out until I get back, late Wednesday. So I'll pick things up on Thursday or Wednesday night, depending on when I get in. And that's it. All right, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.